Let me guess. You're comparing two health plans. One costs $172 per month. The other costs $448 per month. And you're thinking, why would I pay an extra $276 every month? That's $3,312 more per year. That feels like real money. And, in fairness, it is. So you choose the lower number. Because lower feels responsible. Lower feels efficient. Lower feels financially disciplined. Look, most people don't compare health plans. They compare monthly payments. And that's the first mistake. My name is Max, and I spend way too much time thinking about how financial decisions are framed in ways that make reasonable people focus on the wrong numbers. Here's the thing. When you choose a health plan, you're not choosing one cost. You're choosing four. And the one you focus on most is usually the least important. Cost number one, the monthly payment. This is the visible cost. It's predictable. It shows up 12 times a year. Your brain loves predictable numbers. There's a concept in decision psychology called framing distortion. When a cost is broken into smaller recurring pieces, it feels smaller and more manageable, even if the total exposure is much larger. So $172 feels cheaper than $448. But that monthly payment is just the entry fee. It is not the total cost of risk. Cost number two, the deductible, your upfront exposure. Now let's go deeper. Let's say the $172 plan has a $7,400 deductible. The $448 plan has a $1,900 deductible. According to National Hospital Utilization data, the average cost of a hospital stay in the U.S. exceeds $13,000. So let's walk it through. You slip. You fracture your ankle. You need surgery and follow-up care. Under the cheaper plan, you pay the first $7,400. Under the higher plan, you pay $1,900. That's a $5,500 difference. And suddenly the $3,312 you saved doesn't look quite as strategic. Here's what most people don't realize. Low monthly plans aren't cheaper. They are higher volatility plans. They transfer more upfront financial risk to you. Cost number three, the percentage you still owe. Now you might be thinking, okay, but once I hit the deductible, I'm covered. Not entirely. Many plans still require you to pay a 20% coinsurance of remaining costs. Let's continue that $13,000 example. Under the cheaper plan, $7,400 deductible paid, $5,600 remaining. 20% of $5,600 equals $1,120. Now your total out-of-pocket becomes $7,400 plus $1,120 equals $8,520. And that doesn't include physical therapy, prescriptions, or additional imaging. According to the Kaiser Family Foundation, many individual plans now have out-of-pocket maximums in the $8,000 to $9,000 range. That means in a bad year, hitting those numbers isn't rare. It's built into the structure. And this is where it gets really interesting. Health plans are displayed side by monthly payment, not by maximum annual exposure. That framing shapes behavior. Cost number four, the 101 models, income disruption. Now let's zoom out. Let's say you earn $75,000 per year. That's $6,250 per month before taxes. You can't work for 8 weeks while recovering. That's 2 months. 2 months times $6,250 equals $12,500 of gross income disrupted. Maybe your employer disability coverage replaces 60%. 60% of $6,250 equals $3,750 per month. Over 2 months, that's $7,500, which leaves you short at least $5,000, depending on taxes due if the benefit is a pre-tax plan. Now stack it. Medical exposure, $8,520. Income shortfall, $5,000. Total financial impact, $13,520. That's nearly 18% of your annual income from one incident. And here's what most people don't realize. Medical bills are visible. Income disruption is quiet. But income is what keeps your mortgage paid, your utilities on, your savings intact. According to the Federal Reserve Survey of Household Economics, more than one-third of U.S. adults would struggle to cover a $400 emergency expense without borrowing. Now imagine covering $13,000. This isn't about being irresponsible. It's about incomplete math. A second scenario most people miss. Now you might say, but I'm healthy. Fair. Let's model something smaller. Urgent care visit, $1,200. Imaging, $2,000. Follow-ups, $800. That's $4,000. If your deductible hasn't been met, you may pay most of that, even without hospitalization. This isn't catastrophic. It's common, and the math still matters. So what do you actually do? First, calculate your real exposure. Add your deductible, a realistic coinsurance amount, 2 months of income disruption. Now compare that number to your accessible savings. Not your income, your cash. If there's a gap, that gap deserves attention. Here's what most people don't realize. Employer health plans are designed to manage medical billing. They are not designed to fully stabilize your paycheck. Many employer disability plans replace only a portion of income, may have waiting periods, are tied to your job. Some people choose to supplement that gap with personal disability coverage so they control the replacement percentage and portability. Others use fixed benefit plans that pay defined cash amounts when certain events occur. Some explore life insurance policies that include chronic illness features, allowing access to funds under specific health conditions. The goal isn't stacking benefit plans. The goal is closing structural gaps. Often, completing the structure costs far less per month than absorbing the volatility of leaving it incomplete, especially when you're younger and healthier. Financial discipline isn't choosing the lowest payment. It's choosing the lowest long-term instability. Health coverage is a risk-sharing agreement, and the lower the payment, the more volatility you typically agree to absorb. That's not good or bad. It's design. So before you pick the cheapest option, ask, if something happened this year, would I feel stable or stressed? That answer matters more than the monthly number. Thanks for watching. If you're someone who earns steady income but wants to avoid the financial shocks most people never calculate, make sure to hit the subscribe button and give this video a thumbs up. And if you're looking for more ways to make your coverage more cost-effective while keeping your financial foundation strong, watch my other videos where I break down how to reduce unnecessary spending, think long-term, and build smarter financial structures. Because the quiet costs, the ones people ignore, are the ones that shape your financial future the most.